For millennia, gold has been the undisputed king of value storage, a tangible symbol of wealth, a safe harbor through economic storms, a currency for empires. But in the digital age, a new contender has emerged, born not from the earth, but from code: Bitcoin. Initially dismissed as a niche curiosity, Bitcoin has steadily evolved, its narrative shifting from a peer-to-peer cash system to something far more profound. Today, the question on everyone's lips is, has Bitcoin finally ascended to its destiny as digital gold? And what role have the recent flood of spot exchange-traded funds and the embrace of Wall Street played in this monumental transformation? The concept of digital gold isn't new. It's been the rallying cry for Bitcoin enthusiasts since its inception. The comparison hinges on several key characteristics that both gold and Bitcoin share: scarcity, durability, portability, and decentralization. Gold's finite supply, mined over millennia, gives it inherent value. Similarly, Bitcoin's supply is capped at 21 million coins, programmed into its very DNA, making it inherently scarce. Gold can withstand the test of time. Bitcoin, secured by a decentralized network, is virtually immutable. While gold is physically carried, Bitcoin can be transferred globally in seconds. But there's a crucial difference. Gold has thousands of years of history as a store of value, while Bitcoin, created in 2009, is still charting its path. Born in the shadow of the 2008 financial crisis, Bitcoin was envisioned as an alternative to traditional financial systems, a peer-to-peer electronic cash system free from central authority. For years, it remained the domain of cypherpunks and early adopters, its price a wild roller coaster, far from the stable store of value gold represented. The digital gold narrative gained traction as Bitcoin proved its resilience through market cycles, its fixed supply acting as a hedge against inflation in a world grappling with quantitative easing and currency debasement. However, its extreme volatility and the complexities of direct ownership often kept institutional investors at bay. Then came January 10, 2024, a date etched into crypto history. After a decade of rejections, the US Securities and Exchange Commission finally approved the first spot Bitcoin exchange-traded funds. This was not just another financial product, it was a bridge, a regulated, accessible gateway for mainstream investors, both retail and institutional, to gain exposure to Bitcoin. Unlike futures-based ETFs, spot ETFs hold actual Bitcoin in secure custody, meaning their value is directly tied to the cryptocurrency's market price. This approval, a culmination of intense regulatory debate and legal challenges, including a crucial court ruling that found the SEC's previous denials arbitrary and capricious, signaled a seismic shift in how Bitcoin would be perceived and accessed. The impact was immediate and profound. Billions of dollars flowed into these new ETFs within weeks of their launch, making it the most successful ETF launch in history. Major asset managers like BlackRock, Fidelity, and others, which had previously been hesitant, became instrumental in this adoption. BlackRock's iShares, Bitcoin Trust, for instance, quickly amassed tens of billions in assets, even surpassing the assets of some long-standing gold ETFs. This surge in demand, coupled with Bitcoin's predetermined scarcity, was a powerful catalyst, driving its price to new all-time highs throughout 2024. This institutional embrace extends beyond ETFs. Major global financial institutions, including JP Chase, Morgan Stanley, and Goldman Sachs, have significantly increased their involvement, not only by offering Bitcoin ETFs, but also by investing in custody solutions and blockchain projects. Banks like Merrill Lynch, Wells Fargo, and Charles Schwab now provide clients with access to these spot Bitcoin ETFs through their brokerage services. Even global giants like BNY Mellon are making substantial investments. This widespread participation is validating Bitcoin as a legitimate asset class within the traditional financial system, moving it from the fringes to the core. So, is Bitcoin truly the new digital gold? The argument grows stronger. The approval of spot ETFs and the influx of institutional capital have directly addressed Bitcoin's historical barriers to entry, accessibility, and perceived legitimacy. These developments have amplified its scarcity narrative, as large sums are now flowing into the asset, potentially creating a supply squeeze. Some analysts even project that Bitcoin ETFs could see inflows that surpass those of precious metal ETFs. Companies like MicroStrategy, which has held Bitcoin on its balance sheet for years, have seen their strategies vindicated, while many other corporations are now following suit, holding Bitcoin as part of their treasury reserves. This corporate adoption further bolsters the digital gold narrative, positioning Bitcoin as a hedge against inflation and a store of value in an increasingly uncertain global economy. However, the digital gold label is not without its detractors. Critics point to Bitcoin's inherent volatility, which remains significantly higher than gold's. While ETFs have brought in institutional money, the asset's price still experiences sharp swings, leading some to argue it's more of a speculative asset than a stable store of value. The debate persists. Is this a genuine shift in asset allocation, or a new wave of speculative fervor driven by easy access? Some experts caution that Bitcoin's value structure, while different from gold's, is still unproven in the face of true systemic collapse, unlike gold's millennia-long track record. The question of intrinsic value beyond its network effect and scarcity remains a point of contention. Regardless of the digital gold debate, the landscape has undeniably changed. Spot ETFs and institutional adoption have accelerated Bitcoin's integration into the global financial system. This is not just about price, it's about the increased liquidity and market maturity that these developments bring, making Bitcoin more predictable and potentially less volatile over time. It has also spurred innovation in related areas, from tokenization to the development of more sophisticated crypto financial products. While regulatory scrutiny remains, the trend towards clearer frameworks, such as the EU's MiCA regulations, suggests a maturing ecosystem. The influence of Bitcoin, amplified by its new financial conduits, is reshaping how we think about assets, value, and the very future of money. So where does this leave us? Bitcoin's journey from an obscure digital experiment to a globally recognized institutionally backed asset class is a testament to its disruptive power. The advent of spot ETFs and the tidal wave of institutional adoption have undeniably propelled it closer to the digital gold mantle. It offers a unique blend of scarcity, decentralization, and potential growth that gold, with its stability, cannot fully replicate. Yet the volatility and evolving narrative mean the debate is far from over. What do you believe? Has Bitcoin earned its place as digital gold? Or is it still a speculative gamble? Share your thoughts in the comments below. We'd love to hear your perspective. If you found this deep dive insightful, please give this video a thumbs up, subscribe to our channel for more financial explorations, and hit the notification bell so you don't miss our next video. Until then, stay informed and keep exploring the future of finance.